What are your priorities when you're thinking about using technology? Like, what are you trying to solve for, and how is Gen AI supporting that?
So many of our underwriter leaders have told us, and we've heard it as we've gone out into the market and spoke with our brokers, speed to quote matters. And we need to hurry up because we're not meeting expectations or competitors are beating us. What we know from looking at our data and analytics at Arch is if we're first to quote across multiple markets, we have a 50% higher rate of binding that business. So time matters. And quite frankly, the clearance or the intake step of the process is low value in terms of what the broker or the underwriter needs to get something out to the market. So we are, looking to reduce what used to be clearance in days to clearance in hours. And Cytor is a key part of how we're driving towards that outcome.
We're very similar. Well, Beasley were very similar, I should say. We spent a couple of years really investing in distributing our product via APIs, and that is like speed, right? But that's what brokers want: price, speed. But what we've realized and what we've seen now over those same 2 years is our email submissions haven't shrunk. They've kind of plateaued. So we've almost doubled our submission intake via APIs and emails. So what we're trying to do is similar to what you're doing, Allison, which is we need to process those email submissions as quickly as possible, get them through clearance, triage them, and get them into a position. I think ultimately we want to auto quote. That's ultimately where we want to get to.
Overall, my observation has been in last 18 months or so, insurers, especially carriers, are more focused on the use cases that lead to productivity gains. So doing things faster, cheaper, that's been the focus. The biggest excitement for me personally, when you think about AI and technology in insurance, is that you get the most accurate price for the risk in real time. Like, there is a lot of static models that look back and evaluate the risk. So there is a ton of opportunity there, but I don't see a lot of work happening in those domains just yet. And part of the reason is no one wants to be the number one in taking some of that risk. So I see a lot of opportunities in document ingestion, document processing, underwriter and claim support, ton of opportunities in legal, ton of opportunities in actuarial analysis. We don't do a lot of it in our world today, but I was at Allstate. Call centers are probably going to go out of business at some point. So there is a ton of opportunity in some of those domains, but still some gap in the core of the insurance business. Now, we're starting to use Cytor for some of those productivity-related things as well. But my hope is that we continue to move towards where the technology can really benefit the insured ultimately. And there is more work to be done there.
By now, like everybody knows what key is, but just for those who are less familiar or listening from the other side of the pond, like what is key? What does it make it unique?
Yeah, so Key is a very different business in Lloyd's. We have set ourselves out a little bit different in that we're follow only. So most other businesses in Lloyd's are leaders, what you'd think of as leaders who are pricing and structuring risk. We only follow business, so we are price takers, and we're there to fill the capacity that's needed for these large, complex placements that find their way to Lloyd's. But the main differentiator of Key is that we're a digital-first business, data-led, and we underwrite using algorithms. So we're trying to create a new kind of business, which is really oriented towards the future of the market as the market evolves into digital trading. And we thought it would be best to start Key really afresh, if you like. So we built Key within the Brit environment because we had access to Brit's intellectual property, if you like, Brit's data and underwriting know-how and so on. But then what we did is we took a clean sheet approach to the technology and built from scratch in a new and modern data first way. And the thing that gives us that's a real differentiator in the market is we can respond very, very quickly to a request from a broker on behalf of a client. So our current average response time to quote is about 5 seconds, which is pretty dramatically faster than other players in the market. And really our mission is to try and give brokers that follow capacity as seamlessly and efficiently as possible, as quickly as possible, so they can use our platform anytime, anywhere. They can access it across the globe. So it's a rethink, a fundamental rethink of how business can be done in the market. I do think it's worth emphasizing that we're still an underwriter, and maybe we'll get into that in a bit more detail, but the algorithms we've built are underwriting on a per risk basis. They're just doing that using technology, which makes it very much faster than a sort of step-by-step manual process.
I think that's great that one of your focus or KPIs is responsiveness to brokers. But this is something that in other segments of the market, like if you think like obviously small commercial, mid-market, it's a real part of the DNA or the ambition of insurers. But typically in London market, you hear less about that, right? Because I guess historically it's not been a priority or it's been more complicated to do. So I think you're one of the pioneers of really bringing some of that level of service into the London market space.
Yeah, I think it's a great point. And Lloyd's has been through kind of multiple iterations of trying to modernize and iterate the business model. We actually took inspiration from the blueprint strategy process that happened in 2019 and really focused on a digital data-led future for the market. So that was really the prompt for us, if you like, to start thinking about a digital first business and ultimately bring Key to market. And I think to your point, there were a lot of questions over willingness, attitude of brokers to embrace new technology. And I'd say in the first few years, we've really proven that wrong. I think the market has really embraced the technology we've built. We just to give some examples, we've built a system which is now used by over 1,000 brokers in the market. And on an active, ongoing basis, we quoted on over 30,000 policies last year, and we wrote over $1 billion of premium. So it's not a small business. This is a major part of the market now, and embedded into a lot of brokers' daily lives and working habits. So I think the market has genuinely got the ability to evolve and iterate and innovate, and we're delighted with that. And one of the things we're trying to do is to, really, our core business is the underwriting and the algorithm, but we've also built this technology platform, and we do see opportunities for reuse of that technology. So we're working with some other underwriters to let them use our technology and offer digital follow capacity. So there are our capacity partners, and we're also working with, and to be specific, we've got Aspen and Travelers and QBE and Beazley all as capacity partners. So they're using our technology to offer digital follow capacity. And then on the broker side, we're also very open to partnerships as well. And this year, we've been working on a major partnership with Allan, who've really brought a fresh eyes to some of how they trade follow business, and we've helped them with some of our technology. So we're trying to see the market as an ecosystem and be a player in the market that can help others, as well as building technology for our own use.
And from a line of business perspective, how specialized are you in the lines of business you write?
We have our core products, and I'd say we cover, I think the products which are our core products, probably cover about 70% of the business that's placed in the London market. In the main property, casualty, specialty pillars. And really what we're looking for there are classes where there's sufficient data and sufficient scale to apply an algorithmic model. It is a bit different from lead underwriting, where each risk would be heavily researched and constructed on an individual basis, and then the underwriter would typically offer a large amount of capacity. So it's quite a concentrated strategy. For us, because we're more data driven, we're writing more of a spread portfolio and looking for scale in terms of the number of risks we're writing, and more of a follow type line size. So it's a bit of a different strategy, and scale matters in the products we write, but it's those typical property, casualty, specialty classes is our bread and butter.
You've worked at AIG, Kathleen, XXL, all of them very large companies. Now, I wouldn't call Vantage a startup, but you've set it up from scratch, right? And you've had the luxury of defining everything. So I guess first of all, let's do a comparison. Like, what are the pros and cons of a established versus a newer insurance company?
Yeah, so it's a very the wonderful thing about the areas where we participate in Advantage, almost all of them are what I would call excess of loss marketplaces, and so there's multiple carriers on a particular offering, sometimes tens and in some cases 50 or more. So it isn't a zero sum game of XYZ carrier wins the excess casualty and ABC loses. It's much more about you both participate and where you participate. And so there isn't a zero sum game here. My observation around big and small, and we like to call ourselves a young company now. That's where I'm told to call us. So no longer say startup, but a young company, because we're in year 5. So we are starting to hit our stride now. Is that on the one hand, the big company has the advantage of a very large balance sheet, able to absorb greater volatility in outcomes, and therefore able to put out larger capacity. And so that advantage is quite a strong one, particularly as you execute in the markets where we play, which is reinsurance, and then insurance, mostly for middle market and large corporate customers. On the other side, on the smaller, we're able to be very nimble. We respond very quickly because of the technology and the build that we've put together. We've got the ability to get a submission set up in under 8 minutes on average across our insurance portfolio. We're able to sit down on excess casualty and use our technology where a broker and underwriter can meet either in an office or over lunch, and we can get the whole risk submission in, underwritten and quoted right while we sit there. And so those kind of things you can do as a smaller company means you're a little more nimble and a little more leaner. You have to do things in smaller chunks because your balance sheet isn't as big. But that to me is a healthy part of our marketplace. I think the markets that we operate in, our customers want to have multiple choices so they're not over exposed to any one carrier and those outcomes. So I think that neither right nor wrong. You tend to see on the larger carrier side kind of legacy technology debt. We don't have any of that over here. Everything was set up in the cloud. We're able to do a lot more here relative to larger companies because our data is very clean and we're very nimble. But likewise, no, there is definitely an advantage to being a larger franchise with more capital and resources at your disposal, which we are always working hard to minimize that advantage. But there's just that pull and give and take that goes on in the industry.
When you mentioned the standardization of processes, have you got any examples where you've made some progress? And it would be great to bring.
Yep, for sure. So I think some of the areas is, of course, we talk a lot in the market around underwriting workbenches. And I think a lot of those processes, the way that I look at it, there's going to be some variation, but you need to think about what's the common process in a data model that you can have in the entirety of the underwriting journey. So that's one of the areas that has been really critical for us to try and standardize and simplify as much as possible, especially
When you say common processes, you mean common processes across lines of business?
yes, across lines of business. Yeah, across lines of business. So I think when you think about it, even though you can have property classes or casualty classes, there's still very similarities in terms of what they do. We all need to do pipeline management. We all need to do our governance checks, authority checks. There's a number of processes there, even though historically they've been done in different ways, that you can think about standardizing, and you can think about having a data model and use parameterization to cater for differences. So that's been an area that I think we've made some good progress, so that gives us a little bit more scale as we want to roll out. And then, you don't have to build similar to what we talked about earlier in the insurance industry. You don't have to build for 10 different solutions. You build once and then you configure and adjust. And I know, it's the difficult one in the market. There isn't any standard applications out there. It's not like the post-buying journey where you can go and buy something. So you have to really put your creative mind in thinking about how you design that process, but also bring the people along in the journey with you. because that acceptance and adoption is really important. So it's not something that you can just manage from a tech perspective. It's a cross-functional collaborative effort.
And I guess you're referring to processes like, as you mentioned, right? So like upfront risk clearance, sanctions checks.
Yeah, there's a lot of that can happen. I mean, even with what we're discussing with Saito around data ingestion, right? How do you bring data in the organization? The data will be different, but you can standardize that process in terms of how that comes in and how that feeds into your platform. So there is then you don't need to think about 10 different integrations. You do one integration and try to use that capability at scale. But for sure, there is a lot of things that are the more operational part of the processes that you can think about standardizing. And I think I would say for the non-operational part of the process, it's good to think about where we think we can be the same, to what degree, because you can still have the infrastructure and the pipes the same, but then you might have different variations. So I think that's, as I say, like helpful when you have worked in other industries. You don't have to be having common doesn't necessarily mean everything has to be common. I think you just think about what are the different layers of usability you can think about, starting from your infrastructure to actually your application layer, and within the applications, how much of that do you want that to be standard versus where you want to have differentiation, to what degree, based on which process. Some things can be 100% the same, some things might be slightly different, and having that right architecture that gives you that flexibility to be able to do that, so you can almost enforce standardization where you think makes a lot of sense. And in our other areas, you can have a little bit more flexibility to configure the branching of how you want that process to be surfaced to the users.
So most of my professional career in insurance has been with carriers, on the carrier side of things, where you see exactly what you describe of reeking of data points from submissions documents into putting your rating engines or your policy admin system or whatever it is. And recently I was looking at a demo of a broking management system of how what is the day of the life of somebody working in a broker, right? And they were explaining how for some lines of business they have to manually key over 800 data points to even create a submission. So if you almost like step back, and I think that's, I think your perspective now is extremely relevant. If you step back and you position yourself as a customer, and if you knew there's a broker who is rekeying 800 data points into some sort of document and then gets sent to an underwriter who's rekeying the 800 data points somewhere in their systems, who is eventually passing that into reinsurer who's doing the same. I think customers would never understand like why.
Yep.
And
Absolutely.
yeah, and I think this is why. Well, obviously, I mean, I'm obviously biased, right? But AI has such a big potential in the industry to rethink. Obviously, it's not to just improve existing processes. It's just step back and rethink, like, how are we actually, are we doing the right thing for the customer, or are we just transacting risk just because that's the way we've always done it?
Yeah, absolutely. No, I agree. I mean, the other day I booked a room in a hotel and had to key in some information on the form and send. And then I come to the hotel reception on the day, and they gave me a form and asked me to fill in the form. This is probably the way some insurance customers might feel at times. So that's something we can eliminate. And this is efficiency, improving the cost of doing business, and improving customer loyalty. That's simple in practice, in theory, more difficult in practice. I completely get it, because we're a regulated industry, and because we have all this legacy to manage. So it's not only about new business. It's, how do you transform the business model? How do you make sure that all this knowledge in the company remains, that you can upskill people? There's a lot of training involved so that people can adjust to these changes. So it's not without its risks, without disruptions, but the end goal is clear. It's making this industry more relevant in the end, and tackling these gaps in the protection we need to bring to communities, to families, to businesses. So this is crucial to the role of the industry.
Yeah. And if you think about kind of this concept of addressing relevancy through reimagining how kind of the industry works, even if you don't say the name, but of the insurer, broker, or insurer, like have you seen any successful company in the industry really rethinking the operating model and thinking like, okay, we should work in a different way and really making progress, or is the change still quite incremental?
I have seen a number of cases where I was very impressed, particularly by the determination of senior management to make it happen, and use technology for better data management, better efficiency. So there are companies which are clearly in pole position and doing very well, but it's not the majority by any stretch of the imagination. I think the bigger group of companies is still struggling with these issues. So we're not we're still in the middle of the journey. There are encouraging examples, but if I was to compare with the banking industry on this aspect, there are many aspects where insurance looks a bit better, but the banking industry looks better in that respect because they had to face these challenges a bit earlier. There was more sense of urgency and the customers pushing more. That's probably one of the topics. Is that insurance will never be an object of desire. It will always be an object of necessity. So we should not try to make insurance sexy. It's just the ease of doing business, which is important. And that's how you create more business and loyalty. But the banking industry had the pressure from regulators, but also from the customers saying, we need a different way to interact. Otherwise, we leave. In most cases, individuals, they shy away from changing risk carrier for a few bucks difference. So there's an inertia from the customer base, which has to some extent cemented a bit of a status quo mindset. But this is changing because the new generation is much more focused on technology, and they will say, sorry, this is not the way I want to buy this product. Bring me another way. And this is where the contenders have an opportunity, or those insurance companies, incumbents who embrace change and take the learnings and go for that change journey. But these things will change dramatically. So far, customer inertia has been a bit of a helpful toolkit to say, it's not so bad. But the customers will raise their voice in the next decade or so.
Can we actually deep dive into this? I think this is a very interesting area, the analyzers. And you talk a bit more about what is an analyzer, what is the benefit for the client, how do they use them?
Yeah, so the analyzers that we have, we have a number of them. We're rolling out new analyzers as well as new versions of existing analyzers on a very regular basis. In our commercial risk business, we have analyzer. We have a property risk analyzer. We have a casualty liability risk analyzer. We have a cyber risk analyzer. We have a D&O risk analyzer, and those tools are used by our brokers in conjunction with our clients to ostensibly optimize the spend of clients against availability in the marketplace, against the I would say the dynamics of the portfolios of the clients in terms of what they have, and so it's really being able to sort of, I would say, integrate a real-time fact-based conversation with clients that enables them to sort of understand their own risk profile in the context of the availability and pricing of those things in the marketplace. that in so doing creates a different conversation around optionality, around short, medium, longer term objectives, against risk retention versus risk transfer, against vehicles that can be used to bridge some of those things. So you can imagine that captives plays a big role in that as well. But it's really the best way I can often think about it is really taking the awareness and understanding up both sides, both on the capital side as well as the client side, to ultimately create, I would say, better alignment of what the client is trying to solve for and how we're helping the client solve that with solutions that are best fit.
To bring it to life, perhaps so let's take a property risk analyzer. So at what point? So I guess one of your brokers is talking to a client that wants to get property insurance. Like, at what point does the agent look at the analyzer? Like, what type of insights and when are they shared? So perhaps bring it to life in an actual, like, what does it look like with a client?
Yeah, so it's a real time conversation with the client in and around what does their risk profile look like. Depending on what let's take property for sake of argument. Obviously, the thing that normally comes to mind with property is natural catastrophe, right? Natural catastrophe exposures. But within natural catastrophe, right, it's not a zero sum game, right? It's not a one size fits all approach to that. So, really getting very, very detailed around natural catastrophe in, let's just say, different states in the United States, right? So whether it's a Florida versus a Texas versus a California for sake of argument, right? But even within those states, we use a lot of the natural I would say natural catastrophe analytics that we have embedded in our commercial risk and our reinsurance teams to get really, really detailed in and around, specific locations. And within specific locations, it can be the natural catastrophe hazard, or it can be the wherewithal or the sustainability of the location of itself. So, what is it made of? Is it brick, or is it what's the construction of the actual location itself? What are some of the environmental factors that might be in and around that location that could contribute or protect from natural catastrophe exposures? So it's really, what I would say is it's really getting very, very detailed and sort of, I would say, understanding what are the data and or risk dynamics that are influencing the pricing and or availability of capital of a client's risk portfolio, and coming to a sort of level setting on that, so that ultimately the conversations that we can have with clients around optionality, trade-off, which is oftentimes where clients want to go. They want to understand the trade-offs such that they can ultimately come up with a solution that optimizes for what they need, recognizing the risk profiles they have and where we are in the marketplace, and issues they might have in and around the amount of capacity, the amount of limits that they're looking for.
How do you increase the relevancy and the role of Aon in the future of your clients? Like, how do you think about the priorities within Aon? How do you structure, obviously Aon is a very large organization. How do you focus on, what are the 2 or 3 things that really matter?
Yeah, so I think the one of the things that we have done in the last couple of years is actually reorganize ourselves around the interdependent nature of risk. So, we took a decision a couple of years ago to say that, notwithstanding the traditional silos of products and solutions that exist across our industry, we felt that there was a significant opportunity to align our insurance and reinsurance capabilities, as well as our sort of human capital capabilities, under sort of a risk capital umbrella and a human capital umbrella. And then obviously more recently, we've aligned both of them under one leader in Andy Marcel, who is our global solution line leader for the firm. And, that was at the time, perhaps a little, innovative and a little first mover, I would say, in terms of how our industry operates. But what we have found as a result of doing this is that we have found that we are engaging in conversations with clients where the notion of what are we actually trying to solve for is much more front and center in the conversations that we're having with clients. And I would say the other thing that we have seen is, as we have adopted a one data lake approach to coming up with new insights or improving on existing insights, making them more predictive, trying to understand the interdependence between data points that actually allows us to look into providing, I would say, insights against paradigms that have existed for a long time, but new insights against paradigms that's actually going to enable us to solve things that previously were unsolvable. And so that's really interesting. That's really exciting for us. As we generate the insights, our expectation is that as we understand how data points behave under different scenarios, and we can share that with risk-bearing capital, then our ability to be able to bring new capital, as well as increase the relevance of existing capital to those issues that our clients face, means that we continue to be on the path of improving the relevance of our industry to our clients and helping them solve a lot of the volatility issues that they're facing today.